Hey guys, do you want to know about worst stock market crashes in history? Well, in this video, we're going to talk about worst stock market crashes in history. Welcome to my YouTube channel. Before we get started, please make sure you watch the video until the end, so you can find worst stock market crashes in history. And also subscribe with notification bell turned on so you can get notified anytime we upload a new video. Worst stock market crashes in history. Our list of the worst stock market crashes in history takes in every identifiable crash since 1900. In most cases, I've used the Dow Jones Industrial Average to determine the percentage decline and duration of each crash. That's because it was the primary measure of the stock market, at least until the 1970s, when the S&P 500 and the NASDAQ started becoming more standard measures. Here are the top stock market crashes in history. Number 8. February 19th, 2020 to March 23rd, 2020. Percentage decline 34%, duration 33 days. Based on the Standard & Poor's 500 index, the market fell by 34% in just 33 days. Pound for pound, this might have been the most serious crash in history, but it was short in duration, and the market not only fully recovered within months, but went on to set a succession of record highs. The background driver was the COVID-19 pandemic that was quickly sweeping around the world. Unable to stop the contagion, governments around the world literally shut down their economies. The result was not only a massive economic shock, but also a sudden loss of confidence in the financial markets. But quick action by the Federal Reserve to institute more monetary relief brought the crash to an end in amazingly little time. After the market resumed powering forward as if the crash never happened. Number 7. August 25th, 1987 to October 19th, 1987. Percentage decline 36.1%, duration less than 2 months. In some ways, this is the most unusual stock market crash in history. From August 1982 to August 1987, the Dow Jones Industrial Average nearly quadrupled, but it all came to a screeching halt during that same month. The market began to decline gradually, then suddenly on October 19th, in a single day, dubbed Black Monday, the Dow lost 22.6%, making it the largest percentage one-day loss in history. After reaching a record high of 2,722 on August 25, 1987, the market bottomed at 1738 on October 19th for a total loss of 36.1%. The reasons for the crash are still being debated, but what made it really unusual was the rapid recovery. The stock market began recovering virtually the next day. It continued rising after that, though the market wouldn't fully recover from the crash until the early 1990s. Number 6. March 10, 2000 to October 4, 2002. Percentage decline 36.8%, duration 26.8 months. Commonly referred to as the dot-com bust, this crash ranks number 8, but only based on the performance of the Dow Jones Industrial Average. But the real damage was in the NASDAQ, which experienced a decline of about 80%. Based on the NASDAQ performance, the dot-com bust qualifies as the second biggest crash bear market in US history, but the sharp separation between the performance of the Dow Jones and the NASDAQ highlighted two very distinct crashes. As crashes go, the performance of the Dow wasn't particularly spectacular, but the situation was totally different with its NASDAQ. Much of this had to do with the unique nature of the stocks trading on the NASDAQ at that time. The 1990s saw a five-fold increase in technology stock prices. In fact, the growth phase was confined to just 5 years, 1995 to 2000. During that time, technology stocks were awash with venture capital. Nearly any company that presented itself as being connected in any way with technology saw massive gains in share price. Many of the stocks had no revenue at all. It was the very definition of a stock market bubble. The market began to crash as investment capital dried up, and as is often the case, selling begets more selling and crash became self-sustaining. Number 5. October 1939 to April 28, 1942. Percentage decline 38%, duration 32 months. We can loosely refer to this as the World War II crash since it began shortly after Germany invaded Poland in September 1939. After hitting a high of 152 in October 1939, the Dow Jones Industrial Average fell all the way down to 95 by April 1942. This was hardly surprising given the magnitude of World War II and the uncertainty of its outcome in the early days of the war. Not surprisingly, it lasted almost as long as the crash of 1929. Number 4. January 1907 to November 1907. Percentage decline 40.4%, duration 11 months. Commonly referred to as the Panic of 1907, this crash isn't familiar to most investors today. But it might have been the worst crash experienced up until that point. The panic started with bank stocks. Since there was also an economic recession, there were bank runs as depositors went to pull their money out of struggling banks. Efforts to stop the market decline failed, causing the bank runs to increase. The crash resulted in the failure of large banks, causing a contagion to spread to banks across the country. This sell-off on Wall Street fed on itself, culminating in November 1907. Number 3. September 7, 1932 to February 27, 1933. Percentage decline 40.6%, duration 5.75. The crash of 1929 ended on July 8, 1932, but just 2 months later the stock market was back in crash position. Maybe the recovery from the previous crash was nothing more than a bear market bounce, but this one is considered to be a separate crash because despite the severity of the decline, the market never reached the depths of the previous crash. Number 2. January 11, 1973 to October 3, 1974. Percentage decline 48.2%, duration 20.7 months. This crash had been the worst in US history since the Great Depression, at least up until it was overshadowed by the 2007 to 2009 crash. The crash might even more complicated than most in that it had multiple causes. First was the so-called Nixon shock of 1971. Then President Richard Nixon enacted a series of economic and financial reforms in 1971. Most prominent of these was to disconnect the US dollar from gold. Until that time, the dollar had always been convertible into gold at a fixed price. The Nixon administration severed that convertibility, causing the dollar to become a floating currency. This reduced the stability of the dollar and ignited inflation. The market crash was made worse by a combination of economic recession and the 1973 oil crisis, which caused the price of oil to nearly quadruple in October of that year. This sudden and dramatic increase in the price of oil accelerated the general inflation that was gripping the entire economy. The dollar devaluation, the explosion in the price of oil, and the deep recession combined to create one of the biggest stock market crashes in history. Number 1. September 3, 1929 to July 8, 1932. Percentage decline 89.2%, duration 34 months. Without a doubt, this crash is the worst in stock market history. It was the first of a series of crashes that occurred during the 1930s and early 1940s, during the time commonly referred to as the Great Depression. What made the crash of 1929 so severe was that it followed a decade of double-digit annual returns in the stock market. From there, the crash took hold suddenly. Between September 3rd and November 13th, the market lost 45% of its value in just over 2 months. That likely qualifies as the single biggest flash crash in history. Unfortunately, that moved the market only halfway to its ultimate bottom. The worst part of the crash happened during 3 single trading days. October 24th, which became known as Black Thursday, saw the market lose 11% of its value on heavy trading. Efforts by wealthy investors to inject cash into the market and prop up prices failed. Many stocks trading on the New York Stock Exchange had no buyers at all, creating a worst-case scenario. Hundreds of companies filed for bankruptcy after the crash. The crash of 1929 by the numbers. From start to finish, the Dow Jones Industrial Average experienced the biggest bear market in history. After peaking at 381.17 on September 3, 1929, the Dow Jones Industrial Average hit bottom at 41.22 on July 8, 1932. That resulted in an overall loss of 89.2%. The decline was so steep that it would take until November 23, 1954 before the index would finally recover to its pre-crash high. Put another way, if you were invested in the market in September 1929, it would have taken just over 25 years for your portfolio to fully recover. Make sure you stay watching our next related video to discover more amazing videos. If you have any comments, please leave them in the comments section below. Thank you very much for watching, and I'll see you in the next video.